Welcome to the Anton Stetner podcast. And today we're asking the question, should I buy now or should I wait? Because we all ask that question when it comes to mortgage rates. So tell us what we need to know in terms of where mortgage rates have been, are at, and will be at. I mean, just like the globe, right? This is like the crystal ball moment.
Yeah, we're looking into the oracle.
Okay.
So first off, we always want to help our listeners and our audience. And this was a request from the audience. And we will finish off. So we're going to go with like kind of this macro idea of where are rates going, where are they headed. Then we're going to finish off with like 20 ways or 20 hacks that you can use right now in the housing market to deal with rates. And the mortgage market is actually about ready to crush the average buyer because everyone is celebrating or thinking lower rates. But what they're missing is that the average buyer is probably going to have to pay like $40,000 more by the time they're ready in the spring. And so this is one of those things like the mistake might be waiting until rates get actually lower. I went through, did a bunch of research. Rates are projected right now to be between 5.5 to 6.5. Yes, there were some predictions who say rates are going up in 2026. Now, the thing to understand though is this small decline is going to unleash pent-up demand. As rates get to low 6 and below 6, you can see this in the research from Altos Research, from Housing Wire, from the Redfin Data Center. As rates trend low, what specifically happens is buyer activity picks up and it increases massive demand. So the net result is you may pay less in interest, but you might have to pay more for a house. This is going to be the trap that the average person is going to fall into. So this negative trend is basically creating your best buying opportunity in a decade. And I want our buyers, our investors to be prepared for that. And we're going to show you a hack or a system that you can use to take this and turn this into wealth, into actual real money. And at the end of the video, we're going to go through the 20 actionable steps, just like I mentioned. And we're going to talk about the number one tip to where you could get a 4% rate today. So while everyone else is waiting for 5.9, let's just go through the bad news. Like how much trouble is the market in? And I'm Anton Stetner. I've been selling real estate here in the Seattle Metro since 2003. We've closed thousands of transactions. We own brokerages. We literally carry tons of listings. We're avid real estate investors, and I love digging through this data. One of our listeners asked us to do this. This is why we're doing it. So subscribe if you guys want to go along on the journey with us.
All right, well, I'm going to ask the question.
Yes, sir.
What's the rates going to be in 2026? You know, this is the end of the year.
Yes.
Got a couple more months. Winter's coming, right? What is the rates that we can expect in January of next year all the way? Maybe, I don't know how much farther you can forecast and like kind of guess.
I love how you said that because let's be real specific. When we're talking about rates, this is a guess. And there are so many variables that come inside of it. So we're going to go through each one of these kind of rate predictions from the major financial institutions. But to lay the framework for this, let's talk about where we were, where we are, and where things are going. When the Federal Reserve raised interest rates in 2022, they shot up at a historic rate and interest rates hit almost 8%. And the real estate market stopped. Right before the last rate cut, we were all the way down to 6.1. We told all of our investors, all of our buyers, lock in now because as soon as Jerome Powell talks, rates are going to pop up again. The mortgage market is just like the stock market. And it basically, based on the rumor, it moves. And then based on the news, it then reacts. And so it was uncertain like how deep or how much of a rate cut. So the market had overpriced in the rate cut, then it bounced back up afterwards. We expect that same pattern in December for the December rate cut. So we got down to 6.1 right before that. Today we're at 6.3, 6.35.
This is a mortgage rate.
The mortgage rate today on the 30-year fixed debt. So expect in December for us to go to 6 or 6.1 again, and that probably to be the cheapest rates of 2025 going into 2026. We know that right now there are more rate cuts baked in 2026. So everyone's predictions are basically pulling us towards that. And I'm going to give you also kind of what they're laying their predictions on. So Fannie Mae predicts an average of 5.8%, expects modest declines throughout the year. And Q4 of 2026, they expect it to be 5.6%. And this was based on their October 25 housing forecast. Freddie Mac, they only expect 5.9 by a year, and they're a little more pessimistic. One part of the government says 5.9, the other one says 5.6. That is from November 2025. The Mortgage Bankers Association predicts an average of 5.7 in 2026, with 5.5 by the end of 2026. Now, but they make a caveat. If unemployment remains below 4.5. The reason they bring up the unemployment is the Fed moved away from inflation towards starting to stimulate. We recorded a video about that one. We stopped the quantitative tightening. We're going into quantitative easing light, aka the money printer slowly turning back on. But if this unemployment rate starts to scoot up, then they are basically telling you their forecast will be wrong and rates will go lower. Wells Fargo was 5.6. Now, they had a more optimistic outlook due to the aggressive Fed easing scenario, and that was revised here in Q3 of 2025. JP Morgan was at 5.8. Now, JP Morgan, the reason they're on the higher side is they are saying we are still above target inflation, and we believe rates will not come down as quickly because inflation is remaining higher. Bank of America, most conservative, they said 6% by the end of 2026. Bank of America is saying you're basically flat. They're talking about a potential election year volatility, and they're being slightly conservative. National Association of Realtors, they put it at a 5.9 average. So it's interesting. NAR was more pessimistic than the Mortgage Bankers Association. Kind of interesting to see that. US Bank, 5.7. This assumes, though, that GDP growth stays around 2.1. And if GDP growth starts to outpace that, they believe that that rate could go a little bit higher. Citigroup, 5.8. Goldman Sachs was absolutely the most bullish at 5.5%. They expect sub-sixes by mid-2026. They expect a soft landing. This was in notes that they gave to us in October of 2025. So all of this is within the last 30 days. Now I want to give you this idea of like, what is the real cost of waiting? So the median house price here in the United States is around $400K. If rates are basically 6.2 today and it drops to 5.8, and let's assume they put 20% down. This is the actual brutal math. So 20% down, principal and interest for a $400,000 home is $1,959 a month at 6.2%. If it drops to 5.8, that is $1,878. You only save $81 a month. The problem is if homes appreciate during that same time period, like they normally would, you have $20,000 in appreciation basically eating that whole $81 a month. Because $81 a month over 12 months is not even $1,000. So you'd still lose $19,000 in price by rates going down next year. And remember, we've talked about this before, the majority of appreciation happens in the beginning of the year. So in the spring market, it's usually basically starts March, April, May, and peaks out by June or July. And then the market softens towards the end of the year, especially here in the Seattle metro. We have a higher level of seasonality because it rains and we are the evergreen state.
And by the way, these affordable home prices, is this national?
This is national.
National, okay,
yeah.
Got it.
Yeah, and now I'm going to go through some Seattle numbers so we're all on the same page. For the Seattle metro, aka Tacoma to Everett, let's say the median home price in that area is $850,000, which it is for the whole area, with Tacoma, Pierce County being less, King County being the highest at 1.1, and the actual Snohomish County being around 800. Let's assume the median household income is $125,000. Whoo! That's what they need to qualify to be able to purchase this. 30-year fix, 20% down results in $680,000 in principal. At 6.2, that is $4,171 a month. If it drops to 5.8, you go to $4,043 a month or $128 a month. But here in the Seattle Metro, our price appreciation over the last 10 years has basically been between 7 to 8% a year. Let's assume we don't go right back to that. Let's be more conservative. Let's just say it's 4%, about half of normal. 4% appreciation on $850,000 is $34,000. So the home in the spring will most likely, on average, cost about $34,000 by the end of the spring market. And your savings in interest is only $1,536. So this is one of those things when you look at the data and buyers go, man, I just want to wait for rates to come down. Well, if the market appreciates even half of normal, which we expect it to do in 2026. See, we expect the market to pick up and to go faster in 2026 than we did in 2025. The National Association of Realtors, NAR, and Mortgage Bankers Association are talking about somewhere between 600 to 1.2 million more transactions in 2026 because of this tick down in interest rates. In other words, we're going to go from about 4 million transactions to somewhere right around 5 million transactions.
Now, to be fair though, you said it's only $128 savings per month, right?
Yes, sir.
And $1,500 or so per year.
Yeah.
Some people will want the 128.
Yes,
absolutely. Which will drive more demand.
Which will drive more demand. And that's why at the end of this, we've got tips, hacks, tactics that you can use to save money now and even in the spring.
But my point is this just makes this problem even worse.
Yes,
right?
correct.
When you say like the plus 34,000 in home value because there's more demand and sellers are able to raise the price, to what point of the year? To halfway point or just in the spring?
So generally speaking, here in the Seattle Metro, when the cherry blossoms come out, and so it's whenever the first bloom of the cherry
March
blossoms.
or April.
Bingo. That's the start of the spring market. It's all weather dependent. You know what I mean? We're like bad.
Got it.
You know, I mean, we're like old
So you're saying
bears.
that's the height of the
That's
price.
the start.
The start.
So it starts when the cherry blossoms come out, and then it peaks, generally speaking in the data, somewhere right around mid-June to right in the beginning of July.
So this 4% is going into the summer, and then the decline or potentially a just stabilization to the end of the year.
That's almost always what happens.
But what I'm saying is if rates do go down even just a little bit more, right?
Oh, yes.
Then it just goes up. And so the big question is this.
Benji, we can actually do the math for them.
Yeah.
So we did this at 4%. So all you have to do is say, well, what if we went to normal? And just go 8 times 8 is 64,000.
Yeah.
Okay. If the economy gets worse, if unemployment rises and the Fed turns the money printer on even more, and we go to 5.5 in Q2 or Q1 of 2026, expect the normal rate of appreciation, expect 8, which would be 64,000 in this metro.
And that's a thing too. I totally understand the monthly savings, and especially if you're struggling, that's a big deal. But at one point, and guess what? We're in that era right now where people waited for a lower rate, but you're paying so much for the price of the house that the savings is great short term, but long term, you're just stuck with a house that's just so crazy expensive compared to the people that bought like even in 2018, right?
Yeah.
Where you're like, thank you, Lord, I bought at that time, or like me, 2012, right? Like I'm looking pretty. So, and that's always the question. Do you want the lower rate for the lower monthly savings at the risk of higher price, or do you want the lower price and then potentially refinance later, which I don't want to give away your tips or whatever, but
No, and you're going right into one of them. What we have to take into consideration is we still have two major factors that are going to cause this appreciation. Is we have the lock-in effect. The lock-in effect is where people have those 2, 3, and 4% mortgages. It doesn't make sense for them to move into a 6% mortgage, so they just stay in their home. You can see the average time in home went up to 11 years. So that's where it is right now. It's up to 11. It was all the way down to like 6.5 when rates were really cheap because it was affordable to move. Then we combine that, especially here in the Seattle metro, but throughout a lot of the country, with the lack of land development and the lack of new construction. That fundamental lack of housing supply is going to cause prices to push even if rates dip, because there's not the inventory there to supply the demand. And we always want to be sharing this like before it happens. So we're trying to give you the look into the future and realize that all of this is dependent upon, the economy and other factors. We'll be updating you as we go. If you love chatting about real estate, hit that subscribe button and drop your questions below, because we're going to talk here in a bit about how, as a buyer or investor, that you can get ahead of the competition.
All right, but the real question is this. Are we ever going to go back to 3%? That's what everybody wants to know, right? Like everyone's kind of hoping and praying we go back to that.
Yeah.
And I feel like I've heard different answers, but what would you say?
We are not going back to 3% interest rates unless we have catastrophic problems. We get the recession nobody wants. Could we get back to the 4s? That's in the multiverse again. That was not in the multiverse a year and a half ago. But it's in the multiverse again because you see what the Federal Reserve has started doing. How they got us there before was the Federal Reserve purchased a whole bunch of mortgage-backed securities. They were an actual buyer in the mortgage market. They sucked up debt, put it onto their balance sheet, which artificially pulled down interest rates. Now they're starting quantitative easing light. Okay, we talked about that on a previous episode. You can go hit it in the playlist. So we know they're starting that right now, and that'll start to pull down interest rates, but do not expect them to crash back to 3%. That's a hope and a prayer. Where should they be? Long term, they should be in the mid to low 5s is my feeling. The US deficit, though, our 38 trillion in deficit makes our government want to push them into the 4s. So it's because right now, to pay for our own bills, okay, so you got credit card bills, you got car payment bills, all of our listeners, we have bills. Well, the government has a bill all the time for its debt. And right now, to pay that bill is more than we're spending on defense. So they've got to get the rate on which we're paying that bill down. And they really want it to be around 4%. Or excuse me, they want it to be at like 2 to 3%, which would put our debt around 4%. I don't know if the global bond market and the treasuries market will allow that today.
So let's run this back. You're saying we're going to be landing on 5%, maybe long term, based off of historical averages. Like I heard Kevin O'Leary saying 5 to 7% is normal.
Very normal.
That's like normal. 3% abnormal. Okay.
Yes.
And you said we could flirt with 4%, and the only way we're going to get to 3% is like economic crash. Okay. So let's just say 5 to 7%, but the government wants it to be 2 to 3%.
The government wants the treasuries to be 2 to 3%, which would put us at like 4 to 5%. That's what I'm saying.
Oh my gosh. And so right now, if it just stays at 5 to 6%, it puts the government in a tight place.
Correct.
So isn't there some kind of incentive though, good or bad, to get a little bit closer to that 4%? And I know that also just because it's at 2 or 3% the treasury, it doesn't mean that we're going to get like a 4% mortgage rate.
Yeah,
right?
yeah. Okay, we should explain that. Thank
Yeah.
you for bringing that up. The housing industry, our debt is based on the 10-year treasury. You take the 10-year treasury and you add in the spread. When things got all crazy in 2022, the spread was as high as 380 basis points
yeah.
or 3.8%.
When it was good times, there was almost no spread, right?
And when it was good times, the average spread, at one point, I think the lowest it ever got was like 120 or 1.2%.
What year was that?
Don't remember. Historical average, though, is 180 basis points or 1.8%. So you could take the 10-year treasury plus 1.8.
Okay.
Today, we're sitting at when I looked yesterday, it was 2.25. So there's still like almost a 0.5% in spread that as these economic problems come together, that collapses out of the debt right there. Well, a 0.5 point would put you in the upper fives right now. Okay, that puts you at 5.75. So that's item one. Item two, because you would kind of mention this idea of like, what does the government want? And we know what the government wants. The Trump administration has been very specific about what they want. They want the government debt that they are paying at a lower rate because they want to grow the economy quickly. They want to grow GDP. They want to bring manufacturing back home. They want to lock up the borders, and they want tax breaks for an economic boom. And so this is kind of all these things they have to put in alignment. And then, of course, they went and attacked the Fed. And then just this week, Scott Bessent said on CNBC Squawk Box, he was talking about the need for lower interest rates because what's happening is when we don't have low rates, housing makes up about 14% of total GDP. So they also know if they can get rates down, it speeds up the GDP, the consumer is more happy, and we have a bunch of construction jobs. He said, the housing market is in a deep freeze right now. The inventory is low. Affordability is shot. We know everyone's feeling that one. And we're seeing spillover effects into construction and related industries because we've been seeing that stuff slow down. We need to get rates down probably into the fives or lower so we can thaw this thing out and pull the broader market out of this mini recession we are stuck in. So he's already saying right now, we've got to get to 5 or below. And that's our Treasury Secretary. And we know that Jerome Powell is out in May 2026. So
are you talking about the mortgage rate or the Treasury rate?
the Treasury Secretary is talking about the mortgage rate.
Oh, the mortgage rate, yeah.
So he wants to see him in the low fives because they know it will cause the economy to boom. Now, put your conspiracy hat on for a second. If they can get mortgage rates into the low fives before midterms,
which is next year.
Next year, then the Republicans are more likely to get reelected. More Republicans are likely to stay in power. So this is part of a political play.
Let me ask you this. What if you're a betting man, what are the chances that is the case and that's part of the motivation?
So I'm a little more optimistic than most of these rate cuts or most of these rate projections. So the average rate projection was like basically 5.8. I think you are 5.5, 5.4. I'm just a little bit more optimistic. I'm not as optimistic as Bessent, but I'm slightly more optimistic.
Okay, can I make a guess?
Yes, always. Are we going to bet on it?
I think we should bet on it. I will bet this. They will try to get to the number of 4 before then. And I'll tell you why. 4.9 is dramatically better than 5.
Yeah.
You get what I'm saying?
Emotionally.
Exactly. They can say, we got it to 4. Okay. And also there's another, it's not just the political motivation, it's the debt motivation.
Yes.
What'd you say? If it's at 4.9, just do the math, 1.8 spread, right? That puts you at 3.9, 3.1. You're getting so close to that 2 to 3 range.
Yes.
Right? That you're like hitting a sweet spot of you give people the 4, even though it's 4.9. Like what's the difference between 4.9 and 5? It's like nothing. Okay. But you also get the debt to that sweet spot. I'll bet you money. I don't even know how much is in there now. That we get to 4.9 sometime in the next 12 months.
I would love to see that, and I'm just not quite that optimistic.
This is based off of everything you're telling me, though, right? By the way, I'm not a data guy. You're the one that tells me all these numbers. This is putting everything together. I'm chat GPTing this whole rant of yours, and I think it will be. But still, again, you're going to have a problem because lowering of rates before, right?
Yes.
Was happening when prices were going down. Prices aren't going down. So that means prices of homes go up. So that's the big question. Do you want the lower monthly payment or do you want the low house price? And it doesn't change the fact that the next 4 months is like when you want to buy.
So let's look at that from like a national level. There are multiple metros right now that showed some type of depreciation this year, including the Seattle metro, or they've shown it in the last couple months. That's that opportunity. That's the softness in the market. And if rates come down like they are all predicting, and you and I are predicting our own rates, but all of them are lower than today, expect that softness in the market to go away due to the lack of supply and the lock-in effect. Regardless of how you look at it, we're still about 6 million homes behind in the United States.
When is that going to relax?
It's not going to relax because the only places that we can build a lot of homes are the ones that have oversupply. Texas, you can build a lot of homes. Arizona, you can build a lot of homes. Utah, you can build a lot of homes. Well, guess what? Florida, parts of the Carolinas, Texas, they have an oversupply. Everywhere else, massive undersupply.
Got it. Okay, so we talked about where the interest rates could be in a year. We talked about the different factors. What are your hacks to get the best deal in the next 12 months and especially in 2026?
So the number one, and this is the most important, and that's why I wanted to start with it. This is the game changer, the absolute most powerful. It is getting the seller to give you a buy down. And that could be a permanent rate buy down. It could be a 3-2-1 or a 2-1 buy down. Let me explain what that means. If the seller will donate somewhere between 1% to 3% of the purchase price in closing costs, depending on your income and credit and the type of loan that you're getting, you may be able to get rates into the 4s today, okay? Today. You can get it done today. So we just got one last week. It was only like a $9,000
for the life of the loan.
For the life of the loan, we just got one last week, and it was 5.5, and it only cost $8,000 to get it bought down to that. So realize with a slight buy down right now, Benji, you're already in the 5s. This is something everyone needs to be looking into. Number 2. And this is how you're getting these another really cheap rate. This is a specific example. This is the builder rate buy down. So I need you to understand, when you're looking at a D.R. Horton, a KB Home, a Lennar, something of that nature, they go to Wall Street and they go buy debt in a giant block. They bring that debt over and then they provide it to the buyer. So builders right now are running all kinds of incentives, and they're even running them here locally. This is where you could get 4% fixed debt. It's from the builders. The 3-2-1 buy down is it's going to be 3% lower year 1, 2% lower year 2, and 1% lower year 3. If you got that, I feel very comfortable with right now betting, because you just have to look at the 10-year interest rate, that in 24 months from now, interest rates are going to be lower and you could refi. I feel very comfortable with that. I also feel very comfortable with these builder buy downs. We just had one of our investors who made an offer on a duplex, and we found a local new construction community. He is going to get an investor loan at less than 5%, an investor loan, less than 5%. He's going to put quite a bit down. So it's like 35% down. He gets it for less than 5%. It's a new construction home and it will cash flow. And so he's like, hey, I was going to buy the duplex, but I can just buy this, park my cash, no hassle, brand new building. Let's just sit there for 15, 20 years, and then I'll just turn around and sell it before I hit a maintenance cycle. We're like, yep, totally love that idea. Third thing I want you to do, I want you to shop around aggressively. So one thing that's happening right now is spreads start to compress. And as you're looking in the market, there will be lenders running deals. So not all lenders are created equal, and you're going to need to get quotes from at least 3 to 5 of them. This could include mortgage bankers. It could include credit unions. It could include box banks. Now, box banks generally aren't going to give you the best, but I'm just trying to give you ideas. Then you want to kind of pit them against each other. One of our clients who is, how do I say this? He is very meticulous, an engineer type. He put together a spreadsheet of all the fees, the origination fees and the rates, and then the APR and the monthly payment and the taxes and the insurance. So he could compare them all apples to apples, and went and did 10 of them and was able to get about a third or 0.375 lower because he was willing to put in the work. I don't know if most people are willing to do that, but he got, that's quite a bit interest rate. 4, I'm going to say something, and I need you to be thinking about, this is not 2008. Consider getting an adjustable rate mortgage. So when I say ARM, someone in the comments going to say, hey, that's the reason the great financial crisis happened and no one could afford anything and they died. I said, I agree. During the great financial crisis, you didn't have to qualify. Yeah. Today, they qualify.
We learned our lesson.
And
they put like safety nets in there.
So you can get a 5-1 ARM or a 7-1 ARM that is sitting right now about 0.3% lower than the 30-year fixed. So it's fixed for 5 years. That's a great loan today. Get the 5-1 ARM, get it fixed, get it below market interest rates on 30-year, and then just refi sometime in the next little bit. Someone also in the comments is going to say, but there's no guarantee. Yeah, there's no guarantee of anything, okay? But sometimes you just got to push on these things. You could opt for a shorter term. Number 5. Go for a 15-year mortgage. 15-year mortgage always has a cheaper rate. Now, you're going to have a higher monthly payment, but you're going to be able to get a cheaper rate. Next thing you should do is you should work on maxing out your credit score. So many people don't go pull their credit, look at their debt to income ratio, figure out exactly where their credit is and how to maximize it. If your credit is maximized going into a loan, you get cheaper debt. There is a huge difference between a 620 and a 720. And there's a massive difference between like 750 and 800. So if you can get your credit up even further, you will get cheaper, better debt. I brought that in, lower your debt to income ratio. And then also, number 8, put down a larger down payment. When you put down larger down payments on properties, you can get better rates. Number 9, get fully pre-approved. And I'm not talking like, a lot of people like to call the lender, turn in a couple things. I'm talking underwritten approved. So you can do some of these other tactics we're going to talk about later on in this list. Because then when you give your offer to the seller, to the listing broker, whatever it is, and you hand them a letter and it says, this is just subject to title and appraisal, I am fully underwritten, that is almost as good as a cash offer. That is an extremely strong offer. It'll take the average buyer an additional 1 to 3 weeks of work to get fully approved. But I'd recommend in a market like this, jumping through those hoops so you can scalp on price.
Why? And what's that have to do with mortgage rate?
You know the exact rate you're getting, but you can negotiate stronger on the price and on terms because yours is a stronger offer. If you have 2 offers sitting in front of you, one is just a pre-approval letter. That means it's still subject to income, credit, tax returns, all this stuff. That's literally not worth the paper it's written on.
Got it.
The other one says, hey, Anton qualifies just subject to the appraisal and the title. In other words, if your house appraises for the price and you can clear all the liens, he can buy it.
You can get buydowns too, right?
And you can get buydowns too. Next, you want to explore all the government programs. Number 10, that's FHA loans, VA loans, first-time homebuyer loans, USDA loans. You're also seeing a lot of down payment assistance programs happening right now for the people who need help with that down payment. So understand that when the market is not perfect like this, you could go and get a down payment assistance program, basically be able to buy it for 0 down. What if we could also get the seller to pay the closing costs? You literally might be able to buy a property for as little as 1% of the purchase price or a couple $1,000s. That's amazing. We talked about asking the seller for concessions, but let's get very specific. Instead of a price reduction, ask the seller to pay 2 to 6% of your closing costs. There are certain loan products that will allow up to 6% in closing costs. That means you would pay no title fee, escrow fee, lender fee, and you would use all the other fees above that, that other 3% or 3.5% to buy down your interest rate. You're only getting this today. That's the crazy thing.
Do you know any agents in the Seattle area that can help buyers and sellers and investors do this?
We just did this last week. We can absolutely help you. I mean, go to RESG.com, look us up under Anton Stetner and RESG, dial the phone number that you see there on Google, and me or one of our staff will totally be there to help you guys. And I'm just excited about this stuff. I get excited about opportunity. Number 12, target homes with longer days on market. If they have higher days on market, AKA DOM, the seller is getting motivated. So you could go into Zillow, you could go into Redfin, you could have your agent do it, pull the areas you're looking in, resort by days on market, and the ones with the highest days on market with the lowest price per square foot are the cheapest, best deals that you should make offers on. Period, end of discussion. We just sold a home below replacement cost.
Oh, yeah.
We sold a home for $228 a square foot. Why? Because a seller needed to sell. At $228 a square foot, you can't build it for that price. That was a smoking deal. Be flexible on your closing date. So be flexible on the closing date in which you move in. Be flexible to allow the seller maybe some additional time. Because if you're nimble, you can negotiate more. Oh, number 14, leverage repairs for price reductions or closing costs. So when you get the inspection, go renegotiate. I got the inspection. As I was driving here, one of our investors called us. He said, hey, I got the inspection report. He is a licensed real estate broker. We do deals with him. He buys stuff for us. I bought stuff with him. I mean, this is one of those convoluted webs. He's buying one for himself right now. And he goes, hey, I got the inspection report on that duplex, getting it off market, owner financing. Interesting. We've been telling everyone to buy stuff owner financing. 5% interest only. And because it's 2 layers of roof, the last layer was done, like 12 years ago, and there's some stuff. He's going to ask for a price reduction and slightly lower interest rates.
Can I tell you a story?
Yes,
about
please.
This? Okay. Why this is such a good one, leverage repair requests, because a repair request has a retail value to it, right?
Always.
And you can lower it, but it doesn't mean that it costs you that much.
Yes.
I had a flip home in
Yes.
Renton once, and it was one of my first flips.
Yes.
Started out like at 215,000, maybe 225,000. Crazy, right? That a house costs that much. This is like in 2008. Anyways, the buyer found foundation issues.
Yes.
And they're like, this is going to cost at least $25,000 to $30,000 to repair. It's a foundation issue.
Yeah.
I didn't know that much about it, but legit, there was a foundation issue based off the inspection. Okay. I am not kidding you. I was there to hand the keys to the buyer that day, right? It wasn't even the agent. It was the actual buyer. Literally, as I'm like driving away, I look in my rearview mirror. He's already working on the foundation.
100%.
He got the $30,000 repair
Yes.
value. It's not going to even cost him that much because he's probably going to do all the work himself. And I knew in my gut, like, ooh, I got kind of taken because he's doing the repairs himself. He's like a handyman guy. Like, and even post, the other agent told me this.
Yeah.
That he's just doing it himself. And so this is a good example. If you know what you're doing, you have connections, you have relationships with people that can repair it, the seller doesn't want to deal with it. They're like, okay, got to take off 50 grand. Well, then these days, it's about that much.
Exact same thing we're doing right now in Silver Lake. There is a machine in the backyard. We just ripped the deck out. We got 3 bids. The bids were $48,000 to $58,000 to fix the sinking foundation. We ripped the deck out. We took the mini excavator. They cut all the way down right next to it. They're going to cut the foundation right there. They're going to re-pour that part of the foundation and then just lift the whole back of the home up. Because we can do that because we do a bunch of contracting. It's probably going to cost us 15 grand, okay? But you had to be able to send 4 guys there, drop a machine, in order to solve that problem. Item number 15, write a clean, simple offer. A lot can be said when sometimes you just come in and slam dunk. If you can write a cash offer or a simple offer or a quick closing. We tied up a piece of land in Lake Stevens. Originally, they told me they wanted $224,000 for it. I was able to tie it up for $72,000. No feasibility, full risk of the earnest money, all right, let's rock and roll. So I just literally said, here, I'm buying it or I'm giving you the earnest money. Okay. I was willing to take that risk. So sometimes a clean, simple offer can get you a lot off the price. Number 16, search in the off season, AKA winter. That's what's happening. We keep telling everyone it's deal season. Fewer buyers look in late fall and in winter, especially here in the Seattle metro because it's raining. Second, if a seller is still on the market during the holidays, are they motivated? Yes or yes?
Yes.
They're absolutely motivated. Otherwise, they'd take their home off for Thanksgiving and New Year's and Christmas. Number 17, plan for the refinance. So if you chose that ARM or the 3-2-1 buy down, plan for the refinance. Save a little extra money. Be prepared to refinance it at a lower rate. I didn't like what was happening in the mortgage industry when they were saying, marry the home, date the rate or something like that. I thought that was kind of cheesy, but the idea is good. If you know rates are trending in a downward direction, which they are, if you just go look at the 10-year treasury and go look year to date, and to protect yourself, save a little extra cash just in case. Then you'd totally be able to get the refinance. Number 18, when you want to start paying it down faster, what if you made bi-weekly mortgage payments? If you make bi-weekly mortgage payments, you can cut 5 to 7 years off the life of the loan and save hundreds of thousands of interest. Number 19, what if you look for properties that are in a lower property tax area? So here in Washington State, we have high property taxes, but certain counties have much higher property taxes, aka King County, because of sound transit. If you simply shopped outside of King County, you're going to save literally 1% a year on property taxes. It's a big number.
Do you have an example of a couple?
You could just go to Skagit. Skagit County is almost 1% less than King County in property taxes every year, just for an example. And of course, depending on where you're searching and what you're looking for, we could go search out those specifics. Last but not least, number 20, go buy the ugly home. Go buy the cosmetic fixer, the one with the weeds growing, the one that people don't want, the one that you can put the sweat equity into. This is where you're going to make some money. There's negotiating power because of the market, and there's negotiating power because of its condition.
Probably better than ever right now.
Better than ever right now while we're in deal season headed into the fall. And then I wanted to drop in 21, the bonus tip. Go house hack it. Okay. Go buy something where you're going to own or occupy a duplex, a triplex, or a fourplex. Or our favorite house hack here in Washington State right now is go buy it where you could build an ADU or a DADU, an accessory dwelling unit or a detached accessory dwelling unit onto the property. We even have lenders that have set up special mortgage programs right now where you can own or occupy the main house, and they'll give you a construction line of credit up to 90% to LTV to go build the one in the back. That is a smoking deal for my house hackers. So there's the playbook. We've given you the map for 2026 on where we think interest rates are going. Benji and I are even making some bets. And I would even say I'm betting bigger than that, just based on the sheer amount of real estate that we've purchased and where we believe the market is going and all the building permits that we're working on right now. And most people are going to wait for rates to come down because it's going to make them feel good, but they're going to miss out on that fact that as the market appreciates, the change in the rate doesn't compensate for the overpaying in the price. And the opportunity is now. Let's get prepared. Let's get fully underwritten, approved. And we are here to help you inside of the Seattle Metro. If I missed a tip, a trick, a hack, drop it in the comments below and hit that subscribe button so that you can join us on our adventures in real estate and throughout Washington State.